Hi, my name is Pascal Manigat and you're watching the Financial Ownership Podcast. In this video, I'm going to be talking about some of the basics of bonds and how they work. So a lot of times people get the misconception that they think that all of a sudden bonds are always safer than stocks or investment funds, but not necessarily true. Bonds do have different risk classes. I'm gonna go in more detail on how bonds differ in risk class and also how bonds pay and all these type of things that people might want to learn more about before getting into the bond market. But one thing to keep in mind when it comes to bonds, the higher the grade of the bond, the lower the yield or the lower the return is, but the less default risk it has. And the lower the grade of the bond, the higher the yield potential is, and the more risk it has of defaulting later on. So there's something called Moody's Standard & Poor bond rating, and what you can do when you're looking into bonds is you could see what bond you're looking at. Let's say it's an individual bond that you're looking at. You could look at the Moody's Standard & Poor's charts, and you could see if it's rated AAA, or if it's below that, if it's speculative grade, which is extremely risky. You could kind of see based on the prospectus, you can see things on the rating of the bond, and depending on what you're looking for, if you're looking for safer returns and not necessarily higher returns, you just want to make sure that you get fixed interest payout or dividend payout from your fund. Looking more towards the higher rated bonds is going to be key because it's going to be able to give you that consistent rate of return without too much fluctuation, and you don't have to worry too much about default risk. And the other alternative is the speculative grade or junk bonds. Later on, they called them high yield bonds because a lot of corporations realized when you call things junk bonds, people don't want to buy them. So to kind of make it sound a little bit better for marketing purposes, people started calling them high yield bonds because it sounds a little bit better. So when you think about the two sides of the spectrum, if you want to look at the two extremes, so at the top safety ratings where you see the AAA, like the Moody's, Standard & Poor's, and Finch, at the highest grade or prime rating, these are the type of bonds that insurance companies put their money in their general fund, where it's not going to be going in default anytime soon. And bonds can range from different types of maturities. It could be short term, which could be within a year, mid-term, which could be 2-3 years or 5 years, and long term, which could be 10 to 20 to 30 years, depending on which type of bond you're looking for. And generally speaking, if you have a longer maturity, you're going to get paid more in interest as a trade-off for not necessarily getting that entire payoff immediately with having a short-term bond. So I'm gonna go a little bit in detail on, say, if you invested in an individual bond, how that would look like and what the payout would look like and how the structure is. So when you look at an individual bond, let's say the bond value is $1,000. That's the par value or the amount you paid for the bond. Let's say that you bought that bond for $1,000. And let's say the coupon rate or the interest that it's paying is 3%. Most bonds pay that interest rate that they have semi-annually. So if they're gonna pay you 3%, they're gonna pay you in 2 periods of 3%. So 3% of $1,000, that's $30. Dividing that into 2 payments, you would get 2 payments of $15 for that entire year, equaling that $30 3% rate, considering that you put your money in a bond like that. And whenever you want to think about bonds, you want to think of debt or lending. Basically, it's a promise to pay back, and you could get that promise to pay back either from the government, if you're getting it from a government entity, whether it's the state or the federal government, or you could get it from a corporation. Generally speaking, government or federal bonds that you would put your money in would be considered zero risk bonds, meaning that the default risk is literally zero because the federal government could always print more money to give you that bond repayment at the end of it. So generally speaking, let's say that bond period lasts 10 years. So you put $1,000 into it in the beginning, And after that 10-year period of maturity, you basically get that 3% interest payment for those 10 years. And at that end of the 10th year, you would get that $1,000 back. And generally speaking, there's two major risks when it comes to investing in bonds, and it's really important to know this. The two major risks that it comes when you're investing in bonds is credit risk and interest rate risk. And depending on the quality of the bond that you have, it might just be one risk. Because you're invested in a AAA bond, the idea of credit risk is extremely low. But interest rate risk affects all bonds and has a decent effect on the price of the bond and what it's going to be in the future. And the interesting thing about bonds is you have the ability to sell it midway. So let's say you have a 10-year bond. Even if you receive payments from your bond for the last 4 years, say, you can actually sell it that 4th year and get a certain amount for the bond. But the thing is, the changes in interest rates are going to fluctuate the value of the bond. Because if you think about it like this, let's say I currently have a 3% bond, right? Let's say interest rates increase and I'm able to, with that same $1,000 that I previously invested when I first got that bond, I'm able to get a bond that's say 4% rather than 3%. Doesn't sound like a lot, but if you think about it, if all the bonds in the market are currently giving me a 4% rate and you're selling your bond that has a 3% rate, why would I spend $1,000 for one that gives me 3% when there's another one at the same price to give me 4%? So when interest rates go up, that's going to have an effect on your bond price, and your bond price is going to go down. And vice versa is if the price of the bond or the interest rates actually go down. So we're in an extremely low interest rate environment. So if you bought a bond, say a few years ago, or like 5, 10, 15 years ago, interest rates were a little bit higher back then than they are now, because interest rates have been getting to the lowest point that they've historically been. So now, let's say I have my 3% bond now, and later on after a 4-year period, I have the same 10-year bond, but say in the same scenario that the interest rates went down. That means I have my 3% bond, and bonds in the market are currently trading at 2%. If bonds are trading at 2% and mine are 3%, and I decide to go out and sell it in the market, I'm going to be selling mine at a premium or above that $1,000 value, because my bond is more admirable than the current bonds that are in the market, because the bonds in the market are only selling at a 2% interest rate. So I can sell it at a little bit of a higher price because my bond pays more than the bonds that are currently out in the market. So it all depends on what's happening in the market that's gonna change and fluctuate the value of your bond. And this is if you buy individual bonds. So most people nowadays, there's things like you could, from your apps and all these type of things that you could get, there's easy access to funds. Most people aren't investing in individual bonds. And even what I would say, it's better to invest in groups of bonds, because you don't know which bond is going to have a decent interest rate as times go on. So having a big group or a fund of bonds that you can get through certain apps. And you could even get, like through Fidelity, there are some bonds you could have access to that pay monthly dividends. So it's not actually an individual bond you're investing in, it's actually a fund of bonds that pays dividends, and you could get access to that. So that's another way you could get access to the bond market versus investing in an individual bond. But if you want to think about individual bonds, that's generally how they work. They pay something annually, they'll pay a fixed interest rate, say at 3%. And at the end of the maturity of it, after say 10 years that the maturity of your bond, it pays whatever you put in. So if you put $1,000 to buy that bond, at the end of that period is over, you're gonna get $1,000 back. But bonds are very interest rate sensitive products. So if the interest rates are gonna increase, you don't necessarily want to, because if you think about it, interest rates are extremely low right now. How much lower can they get? I mean, they still could get potentially a little bit lower, but interest rates have never been this low historically. Eventually, there's going to have to be a point where bonds increase in price again. But if you think about it, locking yourself into a long-term bond right now, I don't think really makes a ton of sense, because if interest rates are going to increase in the future, why would you lock yourself in to a point where interest rates are the lowest, right? So you don't want to put yourself in a vulnerability to have an individual bond that necessarily doesn't pay a solid rate of interest in comparison to what something might do in the future. So some alternatives to individual bond investing, I've talked a little bit about it. You can invest in funds of bonds. There's a lot of different funds you can use with different apps nowadays, like BLV. It's pretty easy to get access to that fund. Generally with the apps, you don't necessarily need to have a certain dollar amount. You could just put whatever money you have into the fund. So there's no minimum requirement that you have to have a certain amount of money to invest in these funds. So one thing you could do is, like I'm saying, invest in bond funds, which are more liquid too, because you could sell them relatively faster than individual bonds that have coupon rates. And also another thing that I talk about a lot is life insurance programs. Like generally what they do is they invest mostly in bond funds. They invest mostly in different types of bonds. High corporate and prime rated bonds is generally what insurance companies put their money in. So if you're looking for, safe rates of returns and also tax benefits, putting your money into a max funded life insurance contract makes a lot of sense if you're trying to get access to the bond market. And I've talked about different mixes of strategies that you could have. You don't necessarily just have to put your money into a fixed bond index or something like that. There's different ways you could kind of add different high yielding strategies into your life insurance policies. But if you want to learn more about that, I posted a ton of videos on the different types of strategies that you can use to grow your money through life insurance. But that's another alternative to have access to the bond market. And generally speaking, you would be looking at either a whole life policy or index universal life policy to get access to the bond market. And another thing that you could potentially look at is fixed index annuities or indexed annuities. These give you potential returns from the bond market and give you a predictable rate of return that isn't affected by stock market corrections. And nowadays, I think it's more important to kind of find safer alternatives like bond indexes and different types of bonds versus just having the stock market, because the stock market environment right now is very, in my opinion, is very speculative because of all the things like inflation, lowering your interest rates. They're kind of artificially raising the price of stocks right now, where most of the stocks currently are trading at an extremely high PE ratio, which means that they're overvalued. So actually thinking about other ways to put your money and grow your money outside of just only using a stock market strategy is going to be really important as times come, because there has been things in the past, like lost decades, where 10-year periods where the stock market basically didn't grow at all. So are we going to see that again? We're not sure, but or the extremely high prices that stocks are currently trading at now, it's going to be really important to kind of find another alternative to kind of mix in with your current portfolio or your current investments to kind of find safer ways to grow your money along with your investments. If you found some value out of this video, go ahead, like, comment, subscribe. And always, if you have any questions, comments, concerns, I have a link to my website below. Feel free to contact me there or ask any question below in the comments. Thank you.